at its core, the reason we're supposed to be investing is to make our lives easier, make our lives more comfortable. Investing is supposed to be your money working for you. I mean, you already spend the majority of your day working to earn it in the first place. If you're then spending hours and hours researching new investments, tracking the investments you already have, and trying to learn about new strategies that might boost your ROI by 0.5%, is your money really working for you? Or are you just devoting more of your precious time and energy, once again working in the name of money? I love following the markets, talking about making money, saving money, investing money. I mean, I have a finance YouTube channel, for God's sakes. But the last thing I want to be doing in my free time is poring over spreadsheets trying to research my next investment, or listening to earnings calls trying to keep up with the things I'm already invested in. I get plenty of spreadsheets and conference calls at work, thank you very much. I don't need them in my free time too. The goal is to simplify and enjoy life. Just do what's in your control and don't worry about the rest. That's why I invest most of my money in a simple 3-fund portfolio, because there are nearly 4,000 different stocks traded on the US stock market. I can't control which one is going to be the next one to rocket to the moon and provide investors with 100x returns. And I also can't control which stock is going to be the next to declare bankruptcy and go all the way to zero. But what I can control is my savings rate, how much of my money I'm keeping from my paycheck, and how much of that money is going towards my investments. And I do know that the stock market returns roughly 7% per year on average. So with a selection of index funds and a 3-fund portfolio, I know that the stock market will be put to work making my money work for me. I don't have to stress about finding just the right combination of stocks that might outperform that 7% number by a few percent, or worry that making an investment in the wrong stock is going to ruin my whole financial picture. In the words of Jack Bogle, don't bother looking for the needle in the haystack, just buy the whole haystack. I am more than happy just taking that market return and spending all that extra time playing with my kids, riding my bike, and playing more pinball. And the beautiful thing about a 3-fund portfolio is it works just as well whether you're investing your first $1,000 or you're investing $1 million. It works whether you're 20 years old or whether you're 70 years old. And a 3-fund portfolio is simple to build as well, because a 3-fund portfolio is simply comprised of a total stock market index fund, a total international market index fund, and a total bond market index fund. These are funds or ETFs you can find provided by just about any provider out there on the market. If, for example, we look at my M1 Finance portfolio, you'll see I hold Vanguard ETFs. I have VTI, which is Vanguard's Total Stock Market Index ETF. I have VXUS, which is Vanguard's Total International Stock Market Index ETF. And I have BND, which is Vanguard's Total Bond Market Index ETF. But my 401k at work is through Fidelity and only offers Fidelity mutual funds. And unfortunately, it also doesn't offer a total US market index fund. But I can still make the 3-fund portfolio work there as well. In my 401k, I have the 3-fund portfolio comprised of FXAIX, which is Fidelity's S&P 500 index fund. Now is probably a good time to note that you can choose either an S&P 500 index fund or a total US market index fund. I like to choose the total US stock market index fund just because in that you also hold medium and small size companies, where in the S&P 500 index you only get the 500 largest, but the historical returns between the two are nearly identical. So don't lose too much sleep picking one or the other, just pick one and go with it. For the total international market in my 401k, I have VTIHX, which is Fidelity's Total International Market Mutual Fund, and FXNAX, which is the Total US Bond Market Mutual Fund from Fidelity. So no matter where you're investing or whose funds or ETFs you want to choose, you can make a 3-fund portfolio work any number of different ways. And the real beauty of a 3-fund portfolio is that when it comes to asset allocation, all you ever have to change as you progress through life is your allocation of the bond fund. If you're a younger investor or have a more aggressive outlook like I do, you can probably keep your bond allocation at 10% or less of your portfolio. If you're a more conservative investor, or you're someone more near retirement age, your bond allocation might be 50% or more. And a good rule of thumb when trying to figure out your asset allocation between stocks and bonds in your portfolio is to simply take 120 and subtract your age. That'll give you the ratio of stocks and bonds you should have. So for example, if you're 30 years old, take 120, subtract 30, and that would work out to be 90% stocks, 10% bonds. Obviously, you're free to choose whatever suits your style the best, but if you don't know where to start, that's an easy way to do it. How you split your portfolio between the US market index fund and the international market index fund is completely up to you as well. I've got about 65% in US and 25% in international, but you can tailor that to the exact percentage that you like, depending on if you're more bullish or more bearish on the international stock markets than I am. And it goes without saying that I think M1 Finance is the best broker out there for this kind of investing. So be sure to check them out and use my links in the description below if you don't already invest there. Now let's talk about some of the big benefits of the 3-fund portfolio. And the first is you have no overlap in holdings. You've got the total US stock market, in which you own pieces of every stock listed in the United States Stock Exchange. Your total international market is totally separate. It's got only stocks from outside the United States. And then you've got your total bond market, which obviously doesn't have any stocks at all because it's a bond ETF. So you avoid all those kind of hidden overlap problems that a lot of people run into when mixing and matching stocks and other random ETFs. If you don't pay close attention to what each individual ETF holds, you could end up way overweight in certain stock if they're held in multiple ETFs you hold, and maybe you hold shares of them individually as well. Maybe my favorite benefit of the 3-fund portfolio, especially if you're choosing the funds from Vanguard, is they have extremely low fees. The Vanguard ETFs that I chose all have expense ratios of hundredths of a percent. Literally next to nothing. And if you don't think fees are a big deal, just consider this. If you invest $100,000 and earn a 6% return on your money, after 25 years, you would have $430,000 if you didn't have to pay any expenses or fees. If instead you chose an actively managed fund that carried a 1% expense ratio with it, and say you also use a financial advisor that comes with a 1% fee attached, that same $100,000 investment at that same 6% return would only leave you with $260,000. Fees compound just like your earnings do, so a percent here or there may not sound like much, but over time, that can possibly wipe out over 40% of your total returns. And I was going to list this as its own separate benefit, but while I'm on the topic, the 3-fund portfolio means you never have to worry about hiring an expensive financial advisor to make all your money moves and decisions for you, because we've simplified that entire process. And by simplifying that entire process, the 3-fund portfolio also defeats one of the other worst enemies of portfolio performance and overall returns. You. And me. You see, by having the 3-fund portfolio, keeping things simple and hands-off, it means our portfolios are protected from our stupid decisions as well. There's going to be no temptation to chase risky returns in a bull market, no hopping on that train of the next meme stock, and there's going to be no temptation to liquidate all your holdings and panic in a bear market. All you do is stick to my investment motto: buy, hold, and repeat. So if that sounds like the kind of investing you can get into, please subscribe to the channel. Thank you for watching this video, and I think you'll enjoy this one next. I'll see you there.